Alright, let's start from the very beginning and keep this simple. Before we talk about options trading, we need to understand what trading even means. At the most basic level, trading is just buying something at one price and selling it later at another. For example, on January 2nd, 2024, Apple stock was trading at around $180 per share. If you bought one share of Apple at $180 and later sold it at $190, you made $10. If you sold it at $170 instead, you lost $10. That's it. That's trading. Now let's talk about what a stock actually is. A stock is simply a small piece of ownership in a company. When a company wants to raise money to grow, it splits itself into many small pieces called shares. Apple is a huge company with billions of shares. When you buy one share of Apple, you own a tiny piece of that business. If Apple does well, sells more products, and makes more money, people are usually willing to pay more to own part of it, and the stock price can go up. If Apple struggles, or investors lose confidence, the stock price can go down. When people trade stocks, they're buying and selling ownership in real companies. Options trading is different. When you trade options, you are not buying the stock itself. Instead, you're trading a contract that's tied to the stock's price. A really easy way to think about options is to think of them like tickets. Imagine there's a concert happening next month. If you buy a concert ticket, that ticket gives you the right to attend the concert on a specific date. The ticket has value before the concert, but once the concert is over, the ticket is worthless. Options work in a very similar way. When you buy an option, you're buying a temporary contract that depends on what a stock does before a specific date. That contract has value for a limited amount of time, and once it expires, it's gone. Now let's look at what an option contract actually includes, using a real Apple example. On January 2nd, 2024, Apple stock was trading at around $180. Instead of buying the stock, a trader could buy an option contract tied to Apple. Every option contract has three main parts. The first is the strike price. This is the price the contract is based on. For example, an Apple option might have a strike price of $180. The second part is the expiration date. This is the deadline. For example, the option might expire on February 2nd, 2024. After that date, the option no longer exists. The third part is the premium. This is the price you pay for the option. For example, the option might cost $200. That $200 is the full cost of the trade. It's not a deposit. If the option expires worthless, that money is gone. There are two basic types of options, but let's focus on one for now, called a call option. A call option gives you the right to buy a stock at the strike price. People buy call options when they believe a stock's price is going to go up. Let's walk through a full example. On January 2nd, 2024, Apple is trading at $180. A trader buys a call option with a strike price of $180, an expiration date of February 2nd, 2024, and a cost of $200. Now imagine that 2 weeks later, Apple stock jumps to $200. Because the option allows the trader to buy Apple at $180, that option becomes more valuable. The trader doesn't need to buy the stock. They can simply sell the option to someone else. Because Apple moved up a lot before the expiration date, the option may now be worth much more than the original $200. That difference is the profit. Now let's look at what happens if things don't go as planned. Using the same example, imagine Apple drops instead. 2 weeks later, Apple is trading at $165. The option gives the right to buy Apple at $180, which doesn't make sense anymore. No one wants to buy Apple at $180 when it's trading at $165. So the option loses value. The trader doesn't lose $180, they lose the $200 they paid for the option. If Apple stays below $180 until February 2nd, 2024, the option expires worthless. That's what people mean when they say an option went to zero. Now here's the part most beginners underestimate: time and risk. Options lose value as they get closer to expiration. This is called time decay. A simple way to think about time decay is like ice melting. Every day that passes, a little value disappears, even if the stock doesn't move much. That means you can be right about direction and still lose money if the move happens too slowly. The other big factor is risk sizing. In our example, the trader risked $200. That was the maximum possible loss. As a beginner, it's really important to keep that number small. If losing $200 would cause stress, panic or push you into bad decisions. The trade was too big. Options can be useful tools, but they're not shortcuts. They magnify both gains and mistakes. The goal as a beginner isn't to get rich quickly. It's to understand how options work and control how much you risk. In the next video, we'll go over 5 simple rules every options trader should follow to avoid the most common beginner mistakes.